Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get to Dana Diorio, Co-Chief Investment Officer at Envestnet, joining us from Hartford, Connecticut. Okay, so what do you do? It's been a crazy 24 hours within the market. How do you position?
Yeah, that's the big question. It's so funny because actually I'm at our conference in Las Vegas, our Envestnet Elevate conference, and I was just on stage yesterday, literally as the pause was happening, telling everyone to stay the course. The timing was, madness, and kind of showing what had happened on Monday when we had, this false report of a reprieve and stocks, skyrocketed only to come back down. And when you're a financial advisor trying to trade on this, it's absolutely impossible, of course. And so, the messaging then and now is, kind of you've got to stay put. I mean, certainly if you have clients who are not diversified and they're super concentrated, or, a lot of people let their equity positions get a little bit big in this hopes of a pro-growth, corporate type of policy from the administration, that's obviously all, kind of been obliterated. And now we're looking at a picture that's very different. And so you had people who are high in equities. If you're too high in equities, take some off the table for sure. But you really, these are the times that you need to ultimately stay the course and wait it out, or you turn the paper losses into a real loss.
Conference in Vegas. Nobody has conferences in like Sheboygan. They're always in Vegas or Miami or Scottsdale. Dana,
this is true.
I mean, they know what they're doing. Dana, so what about earnings here? I think, I have not seen earnings estimates really come down that much, but I've got companies left and right pulling their guidance and all that kind of stuff. How much earnings risk is out there, do you think?
Yeah, I mean, your last speaker said it, right? I mean, what's going to be crazy right now is you're going to have the first quarter earnings come out. You're going to have, March economic reports come out. And of course, all of these are going to paint this incredibly rosy picture that's not reality anymore, right? In fact, they'll probably be rosier even than they normally would have, because you had folks, pulling forward consumption, pulling forward demand. And so things will look great. And you'll have this series of reports, and this earnings season is going to be part of that. And so paying attention to that, of course, it gives you no information. It's really, what is the guidance? And if you're a corporate planner, I'm not sure you can give great guidance, right? I mean, the volatility of, just what you have to potentially plan for in the short run. And then, if you're, some of the idea here, of course, is, hey, look, let's bring, some of the manufacturing back to the States. Let's kind of encourage people to have CapEx here. But how do you do a long-term plan? I mean, it takes years, right, to bring this stuff here.
Yeah.
How do you plan around that? So I think guidance is going to be probably overly, I'll almost say might likely be overly pessimistic, because nobody really knows what they're dealing with.
Which, to that point, Delta yesterday withdrew guidance, stock popped. Today, CarMax does something similar. I mean, it pulled back its financial goals because of the volatility, but same thing. And that stock's down 20%. So where are we in valuations?
Yeah, well, I mean, obviously we started the year very high. We've shaved a good piece of that, but that was part of the problem, right? We came into the year with that expectation of a bull market, with high valuations as a start, not everywhere, but certainly as an index, right? In a market cap weighted basis, valuations were high. And so, when you come in with high valuations, really everything has to go well. And if you have this exogenous shock, and everybody knew tariffs were coming. It's not as though, this was entirely unexpected. And that's why you have that pull forward of consumption. But the magnitude, right, the breadth of it, how quickly it all was intended to come to pass, that did catch everybody off guard, and, kind of wiped out that picture that rationalized those higher valuations that we were sitting with.
Dana, thank you so much for joining us. Always appreciate getting a few minutes of your time. Dana Diorio, she is Co-Chief Investment Officer at Envestnet, joining us from Hartford, Connecticut via that Zoom thing here.
Vegas, remember?
Oh, Vegas. That's right.
The
She's at
conference in Vegas.
Conference.
Yeah.
Exactly.
Boom.
Boy, Vegas. There we go.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Michael McKee, Bloomberg International Economics and Policy Correspondent, joins us now. So, Mike, it was interesting with the CPI. Bloomberg Economics had the note out that said this wasn't about falling prices necessarily, but it was more about falling demand in travel, leisure, in apparel, in furniture sales, and stuff like that. Walk me through the details.
Well, the biggest drop was in gasoline prices, which is sort of a combination of anticipated falling demand by the gasoline producers, refiners, et cetera, given the impending tariffs. And then we also saw some declines, as you mentioned, in travel prices, and that was definitely tariff related. But the rest of it was sort of mixed news. Food prices were up by food at home, grocery store prices were up by 0.5%, a fairly large gain. Then 2 months in a row where food prices are up. And we saw apparel prices rise, but is that just a natural move, or was that also an anticipation of tariffs? Furniture prices, we get a lot of furniture from China, those were also up. So the report is kind of a mixed news thing, except that the overall good news is it went down. And if you were not going to have tariffs, if none of this had happened, it would be exactly what the Fed would love to see.
Right.
So when do we expect to see any inflation impact in these CPI numbers and the PC deflator? When do we expect, if there's going to be any inflation impact, when do we expect to see that?
It's a little hard to say. Probably, maybe, could be hedged enough here. Next month, this month's data, when it comes out next month, because it could reflect tariffs that the president has already put on. But it's probably going to take a couple of months. Maybe we get something in the May numbers. First of all, companies have to figure out whether their products are tariffed or not. That seems to be bouncing around. And then it's a question of how much stuff people have in inventory they can sell that they bought at the lower prices, how soon inventory actually docks at a port and is the tariffs are applied. So it's kind of hard to say exactly when we're going to see this, but it would be coming. And given the fact that we still have 10% tariffs on everybody, and now these huge tariffs on China, you will see it.
When is the biggest, what are you looking at next in terms of the biggest indicator? Is it going to be inflation expectations? Like, is that going to be the thing that's going to sort of give us that kind of insight?
Yeah, because that's tomorrow, so I'm pitching ahead to all the appearances I will do with you guys tomorrow.
Well, John Tucker's in charge tomorrow, so he will gladly have you on the show.
But University of Michigan tomorrow, the Fed has sort of downplayed the long-term inflation expectations number, suggesting that it doesn't quite reflect reality in the history of the Michigan numbers, but they do worry about the short term, and that has gone up significantly. And they have said, and Jay Powell said, that we are obligated to keep prices down, and we are very worried about the short-term inflation expectations should they become unanchored. So that'll be somewhat big news tomorrow. But I think we're redefining what big news in economic data means here, because once we get to the point that you asked about, when does this hit? Once we get to that point, then markets are going to react to every little data bit. But anything that is up to this point, people are going to say old news.
PPI tomorrow. How do we interpret PPI versus CPI?
Well, PPI is the easy difference to know is that CPI is what you pay to buy things, and PPI is what companies charge to sell things. And we may see some of the China impact in the PPI because we saw those big inventory builds in terms of industrial supplies and things like that in the past couple of months. And so if you were a Chinese company or from anywhere else in the world selling to the United States and there was this rapid rise in demand, you might raise prices. So we could look for some of that tomorrow. But so far, producer prices have been much better behaved than consumer prices. So overall, it hopefully is a continuation of the good news that no longer matters.
Can you clear something up for me? This is the stupid question for me from the peanut gallery. A guy picking up stuff at the port, that's the person who's going to pay for the tariff. It's not the exporter off in whatever
it's
China.
It's not the exporter.
It's the guy in Port Elizabeth, Newark, New Jersey.
Yeah. This is the silly thing that the administration keeps pushing. That what they're talking about is that not that the exporter is going to pay anything, but that currencies, the dollars should rise, and that makes their currency cheaper, and so they. Right. You know, there's an impact on them in that case, and sure, but it's the person, it's the company that bought the stuff.
Yep. So this is the whole story from yesterday. There was like a back channel, what thing that he wanted to buy. Some guy at Bloom's. Anyway,
No,
gotta go back and listen to that.
Yeah. Don't even go into that.
It's a whole different thing. Mike, thanks a lot. Mike McKee, Bloomberg National Economics and Policy Correspondent, joining us now.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, we were debating in the last hour, like if John Tucker is Versace and Michael McKee is Prada. Right. Now they're going to be uniting. So it's like a Mike Tucker kind of Prada Versace thing. All right, Deborah Aitken, Bloomberg Intelligence luxury goods analyst, joins us now. It's funny because neither of them are those things. So Prada is going to buy Versace for about $1.38 billion. Walk us through the intricacies of this deal.
Hi. Yeah, so it's been talked about for quite a while, and we already last night heard maybe that the acquisition price would be down by a couple of $100 million. The big thing here has been that under Capri, Versace has not had enough investment in it over the last year, particularly in the field of the tapestry bid for Capri, which didn't go ahead, and which took a lot of the headlines last year, and where all brands under the Capri banner suffered. We've had Chairman John Idol come back into the business as CEO for Capri, and with the focus really on Michael Kors, which is 70% of the sales. And after a difficult year last year, 100% of the profitability of the company leading into this year. So it's all about turning around Michael Kors, which has 70% of its business in Americas, is at accessible price point, and where actually we think that there'll be much more pressure given the tariff situation and the cost of living on all consumers, and also in the US. If we turn over to the Versace acquisition and what's going on there with Prada, Prada has been one of the top performing companies. It's really done ever so well with Prada for the last few years and gone to normalized single-digit growth. And then it has a brand, Miu within its portfolio, doing ever so well. It's number one on the list index for luxury brands in terms of brand equity, brand heat, with Prada at number 3. And during the December quarter, Versace dropped 3 places to number 14. So we think it shifts Versace into the right hands, into Italian luxury owners who can really work well to try to reinvigorate this brand and the brand equity behind Versace.
Right. Hey, Deb, I'm really interested in the valuation here, being a former banker myself. They're selling this thing for $1.38 billion U.S. dollars. In 2018, they paid $2 billion for this. So a lot of value destruction. Is that a Versace-specific issue, or does that reflect lower valuations in luxury generally?
I would say it's both, but it's mostly Versace specific, because if we look at the size of Versace then to now, the fact that it's given double-digit declines in organic sales growth through the couple of years where actually the market was growing 5% or so, and that 1.7, to put it into perspective on an EV, would have been against traditionally a market for a very solid brand, Versace, with a lot of heritage, running from anywhere from 3 to 5 times, probably 3 times for Versace, given it isn't particularly big, under the what was Michael Kors and then became the Capri group, the expectation was that they would run it from 1 billion in sales toward 2 billion, and that just didn't happen. Right. So that's partly why. I think also because of the state of the market, we started 2025 with the luxury market focusing for low to mid single digit growth. With everything that's going on, we pull that back towards neutral.
Hey, Deb, thanks for joining us. Always appreciate getting your thoughts there. Deborah Aitken, the leading voice on all things luxury. She is a luxury goods analyst for Bloomberg Intelligence. She's based in London.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, here's my Janice story. The first time I ever went to a Starbucks, like 20 years ago, was waiting to go into a meeting at Janice out in Denver, Colorado. I'm not a coffee guy, so I had no idea what to order, so I just ordered what the person in front of me ordered. There you go. That's my Janice story. Laura Castleton joins us, U.S. Head of Portfolio Construction and Strategy at Janus Henderson, based in Denver. Laura, you sit back and you think about portfolio construction and strategy. How do you do that with this volatility that we're dealing with this year?
Well, thank you for having me. There's a couple more Starbucks that have popped up over since I'm sure you were here. Yeah, there's a little bit of volatility going on in the market, making our conversations a lot more in demand, you should say. Very clearly, planning long-term is what we need to be focused on for our clients. Near-term volatility is very extremely difficult. Heading into the tariff announcement a couple weeks ago, we were talking to clients about really staying the course, not panicking, but being more diversified than what we had maybe been in the past.
What does diversified mean? And I know that's a stupid question, but I say that and you look at the 30-year. If I own the 30-year for diversification, I just got burned.
Correct. So on diversification, what we're talking about in our client consultations, it's diversification of that typical 60-40 portfolio, absolutely. But then it's also diversification within the 60 and within the 40. And when we actually survey, so we've worked with over 25,000 model portfolios, over 6,500 clients globally, and recently came out with a piece just kind of isolating the average moderate portfolio that we come across. One of the biggest topics of conversation we're talking about right now today is actually the diversification within the U.S. equity allocation, because that concentration's reached north of 80% of investor portfolios. So it's not just across assets, but it's also within.
Hey, Laura, how about international markets? You know, in the first quarter, the rest of the world's markets really outperformed the U.S., the S&P 500. And that doesn't happen very often. Is that kind of a short-term blip, or is that something that we need to, think about longer term?
That's a very good question. It was very interesting to me to actually get some incoming calls from clients asking about international, because to your point, that has never happened before. I do believe with the tariff policy that's come in, obviously we don't know what's going to happen long term, but it is signaling a structural shift in what we're trying to accomplish longer term with our budget deficits. To me, that does warrant potentially diversifying away from only the U.S. dollar. And so while international markets have been strong this year, there's a shift in how they're spending abroad. They're stimulating their economies, and that warrants having some diversification only outside of just only that heavy concentration of the U.S. dollar.
What do you expect in terms of this volatility? Like, clearly diversification is good for all. I mean, the idea is that it should be good for all investing climates. However, the longer the volatility goes on, the harder it is for investors to stomach that.
Absolutely. So that's exactly what we're coaching our clients through, is very clearly, even in the past week, if you wanted to make some pretty big bets on going into certain areas of the market, let's talk even fixed income markets, you could easily get whipsawed the next day, the next week. And so when you're talking about diversification, you need to be spread across the yield curve, across sectors within fixed income, across regions within equities, and you should start to see some bounces from some of these other areas while other parts of your portfolio are kind of dipping. So we're really talking about staying towards that long-term goal. And luckily, a lot of the clients that we work with are managing money for clients that have a long-term financial plan. So while they're getting headlines every day about the volatility, for the most part, they're being able to coach their clients that volatility happens. This is not outside of the norm, but on a long-term basis that you're still well within your reach of your goals.
Laura, are the folks at Janus Henderson, are you guys, is your base case a recession, or maybe we can skirt past it?
So base case is not recession. That obviously has been coming up into conversations quite a bit more. So it's not out of the picture this year. And remember, before the tariff announcements, growth was already slowing. There was already that lack of confidence within the economy that could bleed into slower growth, leading to a recession this year. So it's not without of the realm of possibilities, but it's not a base case. And it's also not necessarily a doomsday scenario for portfolios. Recessions happen. It doesn't necessarily mean it will be the exact recession we experienced the past 2 times, which were quite severe. And there are ways to plan around that, namely be high quality within your names, focus on the fundamentals within your company balance sheets, and within fixed income, really shore up the quality in your fixed income portfolios as well.
Before I let you go, corporate credit, spreads have blown out. They're continuing to blow out, particularly in high yield. Does corporate credit play a role here?
Yeah, that was one of our biggest overweights we saw in a lot of client portfolios leading into these events, was the heavy allocation to corporate credit, and really one direction spreads could go was wide. We've started to see that, although they've maybe started to trickle back in a little bit. That is still an ongoing risk and easily avoidable in our minds to be diversified across yield curve. So on the shorter end of the corporate credit spread curve, you do get a little bit more insulation from spreads widening. And then within the securitized area of the market, spreads were already a little bit wider. We were able to insulate ourselves from that area by hiding into securitized, but corporate credits are typically that canary in the coal mine, and it's something to watch for that recession indicator going forward.
All right, Laura, thank you so much for joining us. Laura Castleton, U.S. Head of Portfolio Construction and Strategy, Janus Henderson Investors, out there in Denver, Colorado. Great offices out there, great firm. Actually, it was when I was on the sell side, it was the biggest account in Denver. You had to get the vote from Janus, and I did.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.